Now, for an in-depth look at the bond market, I'm joined by Michael Keenan. He is a forex and rate strategist at Absa Corporate and Investment Bank. Michael, always good to have you. I was trying to scare Norbert here a little bit about this increase in rate cycle, and he, very smartly just fancy-footed around it. It does seem that there's just been foot off the accelerator in terms of the fears around rate hikes. What's changed the sentiment in the market?
Absolutely. I think the last couple of weeks, really, rate hike fears have subsided. I mean, if you look at what the market is currently discounting, they're pricing in a very small chance that we'll get any move in rates at the September meeting, and also a very small chance at the November meeting. In fact, the first 25 basis point hike is actually only been discounted more around the January meeting. So I think that's been on the back of a couple of things. We've had CPI numbers coming off a little bit. The GDP yesterday wasn't particularly inspiring, and the currency's been behaving itself. So I think everyone just feels that perhaps the Reserve Bank can, as you say, take its foot off the accelerator.
And what about yields? Why are we seeing a downward trend in terms of the yields on the bonds?
Well, I think they go hand in hand. So on the one hand, we've got these rate hike fears subsiding and the currency getting stronger, but also we've got to bear in mind that there's a large chunk of bond coupon payments coming forward at the end of this month, and then next month we have the big 157 it redeems, and there's some more chunky coupons next month as well. And I think that money ultimately has to find a home, and we think that the bond bulls out there expect it to be reinvested back into the bond market.
And under what conditions then would you say that the current rally that we're seeing in the bond market is likely to be sustained?
Look, I think we've got these coupon and redemption considerations, as I mentioned. We've also got a couple of indices which will see some of those index trackers out there, especially the global ones, actually being forced to almost buy some of the longer dated bonds over the coming weeks. But thereafter it becomes a bit tricky, because at the end of the day, what is going to be the catalyst for any sort of sell-off in the bond market will probably be more hawkish commentary from the Fed and or our Reserve Bank. So we're still watching the central banks very, very closely. Those are the kind of guys that really drive our bond markets, because ultimately they set the policy rate, which then has an effect across the curve.
If we were to benchmark ourselves amongst our emerging market peers, where does South Africa sit? Are we sitting pretty, or are we having a bit of trouble?
I think South African bonds have come back into favour. At the beginning of the year, we found that our South Africa was, the foreign participants are probably underweight South African bonds, but then we've had this turmoil in Russia and Ukraine, and South Africa has actually been a beneficiary of that. So I think now we're sitting in a position more where the foreign market in particular, which is around 38% of our bond market, so it's quite a substantial holding, they're probably back to equal weight now, and it's quite interesting. The kind of yields that we see now are the lowest for things like the 186 that we've seen since December of last year. So all that big sell-off that we saw in January, we've recouped those losses. We're back to kind of a neutral standing. So the fears have definitely subsided.
If we were to take the developments of just the last 24 hours, if we go back to the Russia-Ukraine crisis, in particular Russia saying that they're going to switch off the gas into Europe, is this can we isolate this and say this is likely to have an impact on our own markets back home?
Well, it's been remarkable how risky assets, more broadly speaking, have just really ignored and taken these geopolitical tensions in their stride. And I think that really talks to the amount of liquidity that's out there in the markets looking for a home. The carry trade is alive and well, and again, until the Fed kind of turns off the taps, I think you're going to see the market really brush these kind of developments aside, because typically those kind of geopolitical tensions would spook markets, and risky assets like your emerging markets would probably come under the biggest pressure. So I think we're benefiting from this liquidity glut out there, and that's what's kind of covering over a lot of the cracks. And I think that talks to a lot of sort of South Africa's lingering fundamental flaws. They're still there, they haven't improved, but they've been ignored because of this liquidity.
And before I let you go, Michael, I mean, to a large extent, it seems as if at a global level there could be the possibility of divergence in terms of monetary policy. You were saying earlier that we are keeping our eyes on the Fed, but we're also keeping another eye on Draghi and what he is saying. Should this divergence actually concur with the unwinding of QE on the side and implementing on QE on the other side, How's that likely to impact on our bond market?
Yeah, that's a very good question, and we don't really know the answer because to be quite frank, it's difficult to know whether or not the one will completely offset the other. I think that the dollar as well as the yen have typically been your funding currencies for a lot of these carry trades, and I think that when the Fed moves, we'll probably see a lot of those trades, or at least a good portion of them, being unwound. That could be offset by, to a degree, by more accommodation and stimulus from the ECB, but we're going to have to wait and see how that one plays out. I still think the key central bank to look out for at this stage is the Fed. I think, as I say, because a lot of those positions have been put on using cheap dollars, I think that's the one that will overshadow.
Michael, thank you so much. You always pack so much in 5 minutes. That's a big thank you to Michael Keenan. He's a Forex and Rates strategist at Absa Corporate and Investment Bank.